looking at the 5 categories in which we place our stocks. This is important, right? So you have your micro cap, right? You have your micro cap. So we talk about 300 million, 50 million to 300 million. I'm going to say this. If you don't have a high risk tolerance, stay away. If you don't have a high risk tolerance, stay away. These companies do have huge upsides. They have huge upsides, but the volatility here is high. If you're a new trapper, stay away. If you're still just chilling on the porch, kick your feet. Jose, don't laugh. I want you to stay away. That ain't for you. You feel me? All right, then we got the small caps. All right, now, this is for those who have some skin in the game. You not panicking when the people come, right? When they kicking in doors, you ain't making no sudden moves. You're chilling. Small cap stocks have great upside. They're solid businesses, huge upside growth. If you don't, stay away if you're not with it. From 300 million to 2 billion in market cap. All right? Then we got the mid-cap stocks. So these are kind of like, I would call these our young bucks. So remember I talk about young bucks, gangsters, and OGs. The mid-cap is our young bucks, right? They are young bucks. They rowdy. They with the smoke. But they done been in the game a little bit. They done been, shout to my brethren. Shout to my brethren, Ace Hood, man, my brethren in the building. You dig? All right, so then we got the large cap. All right, let me go back. So we got the mid cap. So mid cap stocks, they're less volatile than small cap, right? But they're not as stable as large cap. All right? Then we got the large cap. So we got the McDonald's, we got the IBMs, right? So these are the ones that have been around for a while. They got a little bread. They got a little stability, right? And then we got the mega cap. We talking big boys. We talking about your Apples, your Amazon, your Microsofts. We talk about them. So I want you to break your stuff down into these 5 categories. Now, watch this. We're going to go a little further, right? Because I want you to dig. Let's go a little further. Let's go to this next slide. So here's what I want you to do. I want you to, when you make your list out, it's a clip. When you make your list out, I want you to write this on your list. Dirt cheap, undervalued, fair value, pricey, expensive. Let's go, y'all. We're going to teach right now. This is a teaching moment. For the dirt cheap stocks, remember, dirt cheap, you want this to be a damaged stock, not a damaged company. It's a beaten down stock and it's oversold due to news because certain news can make a stock go cheap. All right, then we're going to go to undervalued. Undervalued is a stock that's being sold a little less than what it's worth. A little less than what it's worth. It's not dirt cheap, but it's like the stock cost is regular $10.99 at fair value. Right now they're selling it for $8.99. It's undervalued, but it ain't dirt cheap. It ain't $3.99. It ain't clearance sale cheap, right? It ain't trapping in a drought cheap, right? You know what I'm saying? All right, then we got fair value. Like the market is selling it for what it's worth, right? The market is selling to you for what it's worth. And then we got pricey. So like it's $10.99. Like the plug ain't adding no, the plug done put a couple points on the pack. We'll put it like that for all my travelers, right? The middleman done put a little point, like he got it from the plug charged him 12, he charged you 12.5. Like damn. So it's pricey. It ain't too pricey, but it's pricey. It's in our range. You with me? We traveling right now? All right. And then we're going to go with expensive. The plug charged him 12.5. He charged us 17.5. We stay away. We stay away. Here's why. Because at 17.5, We know one thing. A drought is coming. And when a drought comes, we can get it for $12.5. Man.
Yeah, tell me that wasn't no bar, bro. That wasn't no bar.
Hey, this is what Wallstreet Trappin all about right here. This is what we talking about right here. You feel me? Let's go, man. We trapping tonight. All right, so, man, another thing, man. Woo, this was crazy. Remember when Trap said this? Remember when Trap said this? Remember when Trap said this? Amazon will go lower than $90. Trap said this. We said Amazon will go lower than $90. It is now $84. We said this when Amazon was at $120. We said this when it was $120. Hey, don't touch it because it's expensive. It was expensive. I said, hey, it's going to go under 190. It's at 84. I'm giving it a $77 price range. Jose, mark that. Episode 21, Trap said, Amazon, $77 price range. Read them and weep, baby.
Yeah, tell me that wasn't no bar, bro. That wasn't no bar.
Jose got us with a new segment. The new segment we coming up with is Mark My Word. I like that. Mark my word. Mark my word. Mark my word. All right, man, so Amazon erases all of its gains since 2020 and has now dropped to its lowest since 2008, yo. That means everything it made from 2020 to now is gone. It's gone. They're back at square one. So here's what I tell people all the time, right? You cannot buy every dip because you're going to run out of chip. And what happens when you run out of chip for the dip? What happens? This is why we take our time. That's why we take our time. Every dip isn't a buying opportunity. This is why it's important for us to understand what? Value. So this is why I gave you, go back to the last slide, Dave. Go back to the last slide. That's why I gave you this. So now we start writing down every stock, dirt cheap, undervalued, fair value, pricey, expensive. And every time we look at a stock, we put it there. Boom. I like it, but where is it right now? Where is it? I like this stock. Where is it? It's fair value. Okay, cool. I like the stock. Where is it right now? It's pricey. I like this stock. Where it is right now? It's expensive. I like this stock. Where is it right now? It's undervalued. Now what happens is you've given yourself a blueprint. You've given yourself order. You've given yourself direction. You've given yourself a plan. So now you're not just buying, you know where it's at. Until you move that stock to fair value, you don't touch it. Until you take the stock on your list and do something like this. Until you do something like this, you don't touch it. Until you do this, you don't touch it. You don't touch it. Because investing is about a game of returns. It's about getting the best return for your money. Man, God damn. God.
That boy is good. Good and terrible.
That boy good. Let's go, man. Let's go, man. Let's go, man. All right, so check this out. We just entered earnings season. So earnings on October 1st were estimated to go up by 5.8%. What does that mean? That means that even in a slow market, because companies were bringing down their price targets, they were saying that earnings were supposed to increase. Watch this. As of today, they're saying companies will earn less by 1.1%. The question that is, are we in a earnings recession? Okay, Trap, I don't know what that mean. What does that mean, Trap? Like, break that down to me. Give me a little more insight on that, all right? So an earnings recession means that companies are earning 5 to 20% less than what they were earning before, all right? So remember, the bread and butter and the oxygen of any company is how much money can it earn. Thank you, Queen, for the super chat. I appreciate you, right? So are we in an earnings recession? So what I want you to start doing is this. Here's what you're going to do. Like this easy homework for you. If you're going to be an investor, I want you to go look at the company that you're about to invest in and go see how much they earned this quarter. Then go see how much they earned last quarter. Has the earnings decreased? And if so, by how much? An earnings recession is when companies in the market are predicted to earn from 5% less to 20% less. An earnings recession now puts the market in a bad place. Because here's the thing, man, this is good. This is good. I like when I get in my bag like this. Watch this. When companies start earning less, they start moving the goalposts back. Investors see that. And when investors see that, they start selling. Why do they start selling? Because they understand that the consumer behavior has tightened up. When the consumer starts to spend less, companies starts to earn less, inventory sits on the shelves, companies get sold off, we get an opportunity to move our company from expensive to pricey to fair value to undervalued to cheap. God damn, that shit was good. We gotta get an ace hood button. All right, so let's check it out, y'all. Inflation, watch this. Inflation trends continue as the Fed will add another 25 points. Watch this. Many people will miss the rebound as they focus more on the recession than they focus on the companies.